Welcome back to the Self-Educated Economist channel. I'm a self-educated economist, and today we're going to talk about the FOMC meeting. They're discussing quantitative tightening and running off of the balance sheet, and we're going to show how this can have an effect on the housing market. So let's dive right in. In step one, we're going to go over QE, which is quantitative easing, and what it actually is. So over here we have quantitative easing. You have the Federal Reserve and their balance sheet. On their asset side, they have mortgage-backed securities, they have treasuries. On their liability side, they have bank reserves. Over here you have the dealer banks. They have mortgage-backed securities, treasuries, and bank reserves, and their liabilities are the cash that's in the vault, which are our assets as individuals, and their liabilities. So what happens is the dealer banks, this is basically an asset swap. The dealer banks buy the treasuries and the mortgage-backed securities on the market, and the Federal Reserve just swaps those. Down here you can see the mortgage-backed security going over to this side of the asset side of the Federal Reserve's balance sheet, and they swap those for bank reserves, which the banks can use to lend on just the same as they can the treasuries and things. They're just an asset. It's just an asset swap. Well, why this is an asset swap is so important is the mortgage-backed securities, and we'll get into that in step two. So what they've come out and said as of this week, they're going to start quantitative tightening in May. They're wanting to sell or run off $95 billion per month of mortgage-backed securities and treasuries. They're saying to the tune of $60 billion a month in treasuries and $35 billion a month in mortgage-backed securities. So that leads us on to step number two. Step number two. Now this is your mortgage-backed security step. This is what they are and how they're formed. And we start over here with the average Joe and Jane goes to the bank and they make a home loan with the bank. The bank then turns around and gets a bunch of these mortgage-backed security or mortgages together. They securitize them. The SEC puts a rating on them, and then they were flipping them to the Federal Reserve. So your mortgage-backed security is basically made up of different levels of risk. So your red risk down here at the bottom would be the high-risk loans. These may go bad, and then your medium risk, and you would have good risk, and they would all be wrapped up together in one and given a rating by the SEC to where that they could securitize and use this as an asset. So basically, people are going down to their regular hometown banks, especially like the B of A, the Wells Fargos, these guys, and they're getting these home loans, which in turn these guys make into mortgage-backed securities. And if you remember from step one, the Federal Reserve for the last, off and on for the last 14, 15 years has been buying these mortgage-backed securities and putting on their balance sheet. So why this matters is by the Federal Reserve backstopping this process and buying these mortgage-backed securities, that eliminates a lot of risk for the banking sector. So that makes them more apt to want to loan these, make these loans for these mortgages, because all they're going to do is turn around and securitize them and then flip them into mortgage-backed securities, which they turn around and flip to the Federal Reserve. They get paid for the loan. They've already got their money. It's no longer on the bank's balance sheet. If you go back to step number one, where the mortgage-backed security came from the bank's balance sheet and then went over to the Federal Reserve's balance sheet, the Federal Reserve now holds that loan. So this eliminates the risk and makes them more apt to want to lend. So this leads us to step number three, to see what the effects can be on this quantitative tightening. Now we're back to step number three, and we're going to put it all together and show just exactly what, if history is a teacher, what has happened in the past and what we could be looking at. So step number one, we talked about quantitative easing and quantitative tightening, the difference there and how it works. Step number two, we went over what a mortgage-backed security really is and how the banks use them on their balance sheets to lend out. Actually, they were just flipping them to the Fed, most of them, and the risk that's involved there. Now, as step number three, we're going over the FOMC meetings to begin with and what's actually happening and what happened the last time that the Federal Reserve tried this. So quantitative tightening, the Federal Reserve has said they want to sell off their balance sheet and they want to let they want to hold these assets to maturity and sell them off to the tune of $95 billion a month is how much they're wanting to reduce it each month, starting in May. Now, we already have our mortgage rates that are increasing. The Federal Reserve, they have control over the short end of the yield curve. The yield curve is the difference in what each treasury is yielding, and you have anything from a 2-week or 2-month treasury up to a 30-year treasury. When this curve inverts, when the 2-year treasury pays more than, for example, the 10-year treasury, which just inverted a couple days ago, then that's a real good recession indicator. Actually, it's the best recession indicator. When that curve inverts and it pays more to hold the 2-year treasury than it does a 10-year treasury, then recession is pretty well imminent. There's no getting out of it at that point. And the yield curves have been inverting ever since December. The euro-dollar curve inverted in December. The Treasury reserves yield curves have been inverting the last couple of months. Certain points along the curve, the 5s and 10s, the 2s and 7s, and finally the 2s and 10s, and the 5s and 30s, they've all inverted. It pays more to hold a short-term treasury than it does a long-term treasury. So with the mortgage rate, there's the inverted yield curves indicating recession, and the mortgage rates increasing. They're up above 5% now for a 30-year fixed-rate note. So all these are indicators are saying that these banks are not going to be wanting to lend like they have been. Like we went over in step number 2, if the banks make the loan and they securitize it and can flip it to the Fed, that means they're making the loan and flipping it, selling it to the Federal Reserve, and the Federal Reserve is the one that holds the risk. When a central bank holds risk, they're the ones that create. It's not like they don't have to worry about a central bank going bust. If you've got a local credit union and they get too much bad debt, too many people don't pay back their loans, and too many people come asking for their money, then they become insolvent and they can go bust. But the central bank, the Federal Reserve, cannot go bust. They can hold negative equity. And and we've seen this before after World War II with the Bank of Japan. They actually held some negative equity to go. They went in and bought a lot of equities and securities on the stock markets and things to shore up the economy after the war was over, to get everything up and going again, and just wrote it off. Man, because they're the central bank, they're the ones that issue the currency. They have that ability to do that, and it becomes a wash. Whereas if Bank of America tries that, Bank of America will be out of business. So, and we've seen that with Lehman Brothers and Bear Stearns back in 2008. Now, the last time that the Federal Reserve attempted QT, not to mention the rate hikes, the rates were still anchored at 0. But as far as the federal funds rate, the overnight rate that the Federal Reserve controls, back in 2017, 2018, they tried this, thought the economy was in good enough shape that they could sell off some of the balance sheet, they could implement QT, and we got what was known as the taper tantrum. The stock market crashed by somewhere around 20 to 25% in a very short amount of time. and the Federal Reserve come in and propped up the markets and started QE all over again and started buying the long end of the bond yield curve, the 30-year treasuries, and they started buying mortgage-backed securities again. So where we're at now, if the Federal Reserve appears to be wanting to fight inflation, if they raise the rates in order to fight inflation like Paul Volcker did, where he took the Fed funds rate up to 22% to fight inflation in the 80s, that causes recession. And we already got the yield curve inverting. That causes recession. So with all these indicators are looking like recession, then they're still wanting, they're saying they're not going to prop up the markets. They've painted themselves in a corner. They've got a choice. They can either prop up the asset prices, or they can raise the interest rates and fight inflation. So it'll be interesting to see in 6 weeks if they keep up this hawkish stance on fighting inflation, where they're more worried about the CPI number than they are the stock market, and to see how many calls they get from politicians when the asset prices start falling, if we get another taper tantrum like we did the last time they tried this. So where does this leave the housing market? Well, with interest rates on the rise and banks not wanting to take more risk, and they can't sell that risk to the Federal Reserve, they may be less inclined to make the loans. Most of your housing is financed. Not very many people have a couple $100,000 laying around to drop on a house all at one time, so they have to go to the bank to get it. So what that means is they'll be making less loans, and only the best qualified, least amount of risk buyer is the one they'll start loaning to, and they'll be loaning them at a higher rate of interest, which means the principal part of the loan will be less, and that buyer has less purchasing power because the money costs them more. Interest rate is your cost of money. So when the interest rate goes up, the amount of money the buyer can borrow for the same amount of payment goes down. So don't be surprised if the housing market slows down or even crashes. And the last time, 2008, it took it 6 years. The housing market started crashing in late 2006, early 2007. By 2008, we were in the depths of the Great Financial Crisis, as they call it, the GFC. But housing prices themselves didn't come down to their historic lows until 2012. So while it may crash, I don't expect it to crash tomorrow or next month. But when buyers can't buy houses because they can't get the money, that means them housing prices have to come down. So this is how the quantitative tightening can have an effect on the stock market and the housing market. Now, for more content like this, please check out the Self-Educated Economist channel. For personal finances, we have I do a segment on personal finances where we talk about taxes, and we talk about cash flow, and we talk about business, and we talk about different things to help everybody in their everyday finances. And we also go over more macroeconomics. So if you enjoyed this video, please hit the like button at the bottom. Please subscribe to the channel and ring that notification bell, and I'll see you in the next video.